joining us today. We are delighted to have you here and are committed to ensuring this session is a valuable investment of your time. Today's session is going to last 2 hours, and presented on the screen is our agenda for this webinar. My name is Motunari Ashaolu, and I'm a Senior Associate in the Valuations and Modeling Unit at Deloitte. I'm honored to be your moderator for today's webinar. Today's discussion will focus on impairment assessment and how robust financial reporting can enhance stakeholder value. Whether a business is large or small, it is crucial to present an accurate picture of its financial position. You might wonder, why is this important? When companies declare the value of their assets, stakeholders such as investors, lenders, and regulators rely on this information to make informed financial decisions. However, changes in macroeconomic conditions like inflation can impact asset values, making them worth less than previously recorded. This is where impairment assessment becomes essential because it ensures that these values reflected in our financial statements remain accurate and reliable. Our goal today is to deepen our understanding of how proper valuation and impairment assessment help businesses avoid overstating their value, thereby maintaining trust and safeguarding the interest of stakeholders. Additionally, the Financial Reporting Council of Nigeria has established regulatory guidelines outlining how valuations should be conducted for financial reporting purposes. These guidelines are designed to ensure that asset values reflect their true economic worth and that financial statements remain credible and transparent for all users. Today, we have a team of experts who will be facilitating this webinar. The lead facilitator, being Abimbola Ogundare, is a partner and West Africa strategy and transaction leader. Abimbola has over 16 years of experience. She will be supported by Sulaimon Ishola and Tumise Omole, who are senior members of our valuations and modeling team at Deloitte. Before we proceed, let's quickly review a few housekeeping rules. To minimize distractions, please keep your microphones muted unless you are speaking. We encourage you to interact with us through the chat box, and rest assured all your questions will be addressed during the Q&A session. On that note, it is my absolute pleasure and with a big smile on my face to invite Abimbola Ogundare to open our discussion with our welcome address and to provide an introduction to valuation in the context of financial reporting. Please join me in giving a virtual round of applause. Please, I want to see your emojis. Thank you. Over to you, Abimbola.
Thank you, Motunrayo, and an absolute pleasure to be here at our second edition. Good morning to our esteemed audience. My name is Bimbola Ogundare. I look over our West Africa Strategy and Transactions team here in Deloitte. On behalf of the Valuations, Modeling, and Insights team, I warmly welcome you to this second edition of our Valuation for Financial Reporting webinar series. Our experienced facilitators will spend some time with you today just discussing knowledge, insights, best practice on this important topic. You know, we thought very carefully through the theme, enhancing stakeholder trust through financial reporting. And it's coming at a pivotal time when the Financial Reporting Council is setting new regulations that will guide the standards, the transparency, and consistency of financial reporting valuations in Nigeria. It's an important foundation for all stakeholders to build trust in any economy. I'll talk very briefly through a number of items, why valuations in financial reporting stay important, and then a little bit about what can go wrong if we don't stick to the rules of transparency, consistency, and the role of building stakeholder trust, essentially. The first one is, very basically, accurate representation of assets and liabilities. Across an entire economy, the real trust that we can place in the value of the assets is the fundamental basis of measurement, the full disclosures, the transparency. And if valuations are not done properly, then financial reporting itself does not reflect fair value, only historical costs, meaning that we cannot accurately rely on those estimates. The other reason is compliance with accounting standards. So accounting standards make sure that across any jurisdiction, any industry, any sector, you have a consistent set of rules and disclosures, whether it be based on IFRS or FRC adopted standards, to make sure that if I pick up the financials of one company in northern Nigeria versus another in southern, eastern, western Nigeria, the fundamental rules and basis on which those numbers are prepared are the same. Now, for decision-making purposes, you also want to make sure that management, investors, regulators are able to rely on information for strategic and financial decisions. This is important because the decisions are either right or wrong on the basis of the information that has been provided. And last but not least, performance management. You need to be able to track that there is growth or decline in companies and by extension assets from one period to the other. Otherwise, there is really no measure as to whether value is being created or destroyed. Now, if we take a little time to focus on the implications for each of the user groups of financial statements, on what it means if the valuation is done properly or not. For investors, the implication of accurate valuation is that they are able to stake confidence on the financial health prospects of the companies that they look at, and by extension are able to make better decisions. Where the reverse is the case, then poor investment decisions lead to value erosion. For management, they need to be able to make accurate strategic decisions based on the performance of an asset or a company, as the case may be. Where the information is distorted, then wrong decisions may be made and value will ultimately be eroded. For auditors, there needs to be a strong basis for whether they issue a positive or adverse opinion. And we all know that the ability or the strength of any economy is whether you can rely on what the companies say that they are worth, and indeed if they are strong and viable. Where you have an economy where the auditor's word cannot be relied on, then you have a bunch of assets or companies that you don't know if are viable or not. And for regulators, the regulator needs to be able to monitor and see how companies are reporting at any point in time. If the regulator is to do his job properly, then he must be in a position to say yes, where companies are doing well, and to impose sanctions and penalties to keep the order, where companies are flouting regulation or taking shortcuts. And for creditors, entire portfolios rely on the quality of credit. The creditor needs to be able to say whether the payback period makes sense, whether this money will be repaid if it is deployed in company A versus company B. And if the valuations are wrong, then ultimately there will be an increase in non-performing loans across the economy. And then if we zoom out just a little bit, we'll recognize that valuation for financial reporting cuts across quite a number of application areas and standards. We have to think through inventory valuation, PPA valuations, intangible assets, are they measured correctly? Where you have funds and collateral items, are they carried at the right amount? Biological assets, they require a little bit more nuances than traditional tangible assets. But in all of that, our focus today is really on impairment testing. And as we continue the conversations, we'll delve a little deeper into what we should be focusing on for IAS 36. Now, I had mentioned earlier that, this is a timely conversation because the FRC is coming up with a set of rules and regulations, a regulatory framework essentially in Nigeria for valuation services, just to strengthen our reporting framework. Now, what are the objectives? If I distill all of this into one primary objective, it would be that there is clear, consistent, reliable, and transparent reporting of valuations for financial purposes. This covers all registered valuers, and the valuation relates to all financial assets, non-financial assets, intangible assets, and anything that forms the bedrock of net worth for a company. Now, the regulation posits that there should be at least a few items that guide how valuations are done. In terms of the structure of a valuation report, there should be an executive summary, which is a highlight of the value of the asset. The methodology and the rationale should be very clearly stated. The key inputs, sensitivities, assumptions, very clearly stated, as well as any supporting items neatly detailed in the appendices. In terms of compliance frameworks, we have IFRS 13, fair value measurement, IFRS 3, business combinations, IAS 36, which is the subject of our conversation today, impairment of assets, and IAS 38, intangible assets. From a documentation and audit readiness standpoint, there should be an end-to-end audit trail. The source data, assumptions, model, and results should be calibrated in a way that they are easy to review. There should be justification for all critical judgments, evidence of governance, especially where there is model variations, just to validate what has been done, and some documentation around sensitivity and scenario analysis. And the last point to just touch is minimum disclosures that should be in any valuation report. These include the purpose, the methods, the key assumptions, the valuation date, any risks and uncertainties, as well as disclosure of compliance with relevant financial reporting standards. Okay, so this is a brief introduction. I'll hand over to the team to continue with the rest of the session. I'm super excited because it's a very important conversation, and we'll be happy to spend the rest of the time with you to delve into these important items. Thank you.
Thank you, Abimbola, for the insightful introduction. Good morning again, distinguished audience, and thank you for joining today's session. My name is Tumisho Molly, and I'll be taking us through goodwill impairment, touching on what impairment is all about, the IFRS standard that guides it, as well as a critical area in impairment testing, which is goodwill, up to the components of impairment testing. Well, before we go into all of that, let's just have a quick quiz to just test our knowledge of what we've discussed so far. and you can put your answers in the chat box. So the question is, which of the following is not considered a purpose of valuation for financial reporting? A, accurate representation of assets and liabilities. B, performance measurement. C, knowing the qualities of employees. D, decision-making support. Okay, we'll just give ourselves a few seconds to get in more responses. Okay, I see lots of C, and that's correct. Um, Knowing the qualities of employees is not considered the purpose of valuation for financial reporting. A, B, and D are some of the purposes for which valuation is done in financial reporting. Thank you all for paying attention and participating. Okay, so we're going into impairment assessment at this point. We can just go to the next slide. So I'm just going to begin by putting impairment assessment in very simple terms. It's essentially about asking whether, an asset is still worth what we say it is worth. It is the process of checking whether the economic value or benefit you expect from an asset can still be recovered, you know, in today's current realities or based on current economic realities. If the assets or business can no longer generate the benefits which we originally anticipated, then it means that there's a challenge or there's an impairment. And IAS 36 requires us to reflect this change transparently in the financial statements. In stable environments, this is quite straightforward, as IAS 36 just requires you to look at relevant indicators of impairment, and once you are done assessing those indicators, if there's no challenge, you do not need to perform further analysis. But in an environment where you know, is unstable, there's instability, there are economic challenges, you know, the volatility of economic variables and evolving regulatory requirements will then makes impairment assessments become necessary. And it's also strategic because it then ensures that the balance of assets or the value of assets that you have on your financial statements are credible, defensible, and they show the true performance of the business. Now, impairment is applied to various assets, such as goodwill, property, plant and equipment, intangible assets, financial assets that are not under the purview of IFRS 9. Investment properties carry that cost as well. So impairment, it's quite broad, and it's very important to, making sure that your financial statements reflect the true economic value of your assets. You can go to the next slide, please. Okay, so we're talking about goodwill impairment, and on that foundation of what impairment is essentially about, there's a key part of IS 36 that talks about goodwill impairment, and it's really about assessing whether the value or additional value that you've paid for the fair value of the identifiable net assets of a business are truly performing as expected, or they are delivering the value that you had anticipated. So goodwill is essentially the extra amount that you pay for a business because you expect certain synergies or advantages from that business combination. It is the amount you pay above the net identifiable assets of a business. Now, when the net assets that you have then identified from the business combination then fall below what we call the recoverable amount. You know, it means that there's an impairment, and then an assessment needs to be done to write down the goodwill. That is the premium paid in acquiring that business. But before we go into all of that, we need to understand some key concepts around goodwill impairment assessment. There's a concept of cash generating unit. After the business combination is done, allocation of goodwill has to be done as well. Now, goodwill doesn't generate cash flows on its own, and it doesn't make money for the business on its own. It is tied to the assets that generate those cash flows, the assets that will benefit from those synergies that are expected in from that business combination. And so your cash generating unit, or what we call CGU, is the smallest part of the business that can generate cash flows on its own, independent of other areas in the business. Now, impairment test. Impairment test basically says, what is my carrying value for this asset? What is my recoverable amount? Is my recoverable amount more than my carrying value? Or otherwise, if my recoverable amount, which is the expected economic value I expect to get from this asset, is lower than what is being shown in my books, it means there's an impairment and I have to reduce the value of the asset that I've recognized in my financial statements. Now, the difference between the recoverable amount and the carrying value is what we refer to as impairment loss. Okay, moving on. Now, there's a standard that guides impairment assessment, and that's IS 36. And what it basically does is to ensure that what you've put on your financial statements actually reflect the true worth, the intrinsic value, or the economic value that you expect to get from the asset. And that's what the scope of IS 36 essentially covers. Now, it covers things like PPE, intangibles, but as well, there are areas that are sort of excluded from IS 36 that fall under the scope of other standards, such as IS 2 or inventories. Now, what's the frequency of testing? For goodwill, it's a requirement by the standard that impairment is tested annually and whenever there's an indication of impairment. Now we'll still look at the other indicators. The indicators can either be internal or external, and we'll look at all those details as we progress in the conversation. As earlier described, goodwill does not generate cash flows on its own, and therefore it must be attributed to the business or the assets that would make use of the synergies from the purchase of the asset or the business combination. Now, what's the recoverable amount? That's the amount that you expect that that asset can deliver in its use. Now, in assessing goodwill, there are two types of recoverable amounts. One is the value in use, and the second is fair value less cost of disposal. Now, the two of them speak to fair valuation. Now, value in use is essentially the cash inflows and outflows that is expected from an asset and then discounted to today's value. So basically, you are present valuing those cash flows from the expected use of the assets. Now, fair value less cost of disposal, it's more of a market indicator or market approach, which sort of says how much is this asset worth in the market? If I want to sell this asset, how much can I recover? And then you exclude additional costs such as transaction costs, legal fees to bring the asset to the point where you can sell the asset. And so The recoverable amount is usually the higher of the value in use and the fair value less cost of disposal. Now, in practice, you do not necessarily have to compute the two of them. If, for instance, you have made use of the value in use and your value in use is higher than the carrying value on your financial statements, it means there's no impairment, and therefore you do not need to do a further assessment using fair value less cost of disposal. So using either of them would be fine in practice. Now, market-based fair value, that's as I've described, looking at the market and assessing what an asset is actually, worth today. Impairment loss recognition. When the carrying amount exceeds your recoverable amount, it means there's an impairment, and then you definitely need to recognize that impairment in your financial statements and write down the value of the asset. Now, moving on to reversal of impairment. For goodwill of IAS 36. Outside of goodwill or other assets, there are indicators that can be assessed to determine if you can reverse impairment. But when it comes to goodwill, the standard does not permit a reversal. Okay, moving on to the next slide. Now, we have standards that guide goodwill recognition. Goodwill is not internally generated and can only arise as a result of a business combination. And that happens when a company buys another and pays an amount that is higher than the fair value of the identifiable net assets of the target business. And so the difference then becomes what we call goodwill. So IFRS 3 basically guides, the process of allocating the purchase price and then the recognition of goodwill at the end of that process. Even though IS 36 has said that we should assess fair value of the assets using either the value in use or the fair value less cost of disposal, IS 36 doesn't make provisions for how you determine fair value measurements. And so we have to reference IFRS 13, which provides the framework for us to perform fair value assessments. Okay, next slide. Okay, now we're going to be looking at key aspects of goodwill. As I said earlier, goodwill is not internally generated. It's basically from business combination and falls under the purview of IFRS 3 when you're going through the purchase price allocation process. So in simple terms, uh, you are sort of um, valuing the assets, checking whether the fair value of the identifiable net assets exceed the purchase price or are lower than the purchase price, and then the excess then is what becomes your goodwill. Number two, goodwill is only recognized and presented in the acquirer's consolidated financial statements, right? When you buy a company and acquire control, meaning that you then now direct the relevant activities of that business, the transaction is accounted for as a business combination. And at that point, as the acquirer, you can recognize the goodwill in your consolidated financial statements and not in the separate financial statements. And that's for, if you have majority interest following the acquisition. Now, the flip is when you've done the acquisition and then you're a minority interest. Now, the goodwill in this scenario is presented in both the acquirer separate and consolidated financial statements. Now, four, goodwill is required to be allocated to the appropriate CGUs on date of the acquisition. It is a must that goodwill is allocated to the appropriate CGU because goodwill does not generate cash flows on its own. So it must be linked to the business unit or a group of business units that are expected to benefit from the synergies of this acquisition. And then this allocation forms the bedrock or the foundation for future impairment testing and analysis. 5. Goodwill is tested for impairment on an annual basis. It is a requirement of the standard. Whether or not management believes there's a problem, it is compulsory that management performs this annual check. And this ensures that the goodwill balance in the financial statements is not overstated and still reflects the true economic value that can be derived from it. Now, 6, if impairment is identified in the CGU to which goodwill has been allocated, the impairment is first attributed to the goodwill before other assets. Now, you can think of goodwill as the softest and least identifiable asset. And therefore, if the recoverable amount of the CGU is lower than the carrying amount, we write down the goodwill completely first. Only after you have exhausted goodwill, that's when you then allocate the remaining impairments across other assets in the CGU on a pro rata basis. Now, for goodwill, impairments can never be reversed. It can never be reversed. Unlike other assets where reversals can be are allowed when conditions sort of improved, for goodwill, that is not the case. Once it is written down, it stays down. Okay, now we'll look at goodwill and its life cycle. We have described how goodwill comes to life from a business valuation. Now, from a business combination under IFRS 3. Now, on day one, you allocate this goodwill to cash generating units. And during the lifetime of the goodwill, you can consider it for reallocation in rare cases or maybe disposal of the assets or the organization or restructuring of the business. And for that instance, you then make sure that the goodwill is allocated to the business units or cash generating units that are expected to enjoy the economic value of that goodwill. So in that instance or in those instances, you can consider reallocation. After allocation is done, you then test for impairment annually. If there is impairment, if it exists where the recoverable amount is lower than the carrying value, it then means you need to impair the goodwill balance. After you've exhausted the goodwill balance, then you allocate to the other assets in the CGUs, which means the goodwill has then come to its death. And that's what this life cycle is essentially trying to depict. Okay, next slide. Okay, now we are looking at the process for testing goodwill for impairment. Now, because goodwill is attributed to a cash generating unit, so the first thing you need to do is to identify, because goodwill is not tested independently of the cash generating unit. It provides certain benefits to the CGU, and so when you're doing your impairment testing, it must be done on that basis as well. Now, in when you are done identifying the cash generating unit, you then determine the carrying amount of that CGU. Now, the CGU's carrying amount, it would also include the goodwill. It would include all assets associated with that CGU, include the goodwill as well. And in rare cases, it will include liabilities associated with the assets of the CGU. And an example would be if a CGU makes use of leases and then it has rights of use assets as part of the assets in this box, which means that there's a lease liability that is associated with the cash flows that CG is able to generate. And in such an instance, you then have to factor in that lease liability. Now you estimate the recoverable amount using the value in use and fair value less cost of disposal. The higher of the two is what we refer to as the recoverable amount. Now, and then you then compare the carrying amount with this recoverable amount, and then the output to determine whether there's an impairment loss. And if there's an impairment loss, you recognize that impairment loss by first reducing the goodwill, and then when goodwill is exhausted, you then allocate it on a pro rata basis to other assets in the CGU. Okay, at this point, let's take another quiz to test our understanding of the things we've discussed so far. Okay, so the first question. Goodwill is subject to impairment testing at least dash under IFRS. A, quarterly. B, biannually. C, monthly. D, annually. Okay, I can see lots of responses in the chat box, and everyone seems to be selecting D, and that's correct. Fantastic. Let's move on to the next. Now, let's sort of look at indicators of impairment. Remember that under IAS 36, it talks about asset impairment. And what it basically says is that you need to consider internal and external indicators of impairment, and that would help you now determine whether you want to then um, continue your analysis of whether an impairment exists or not. So typically the first step is to even assess the indicators of impairment. Once the indicators have been assessed, for other assets that are not intangible, indefinite life intangible assets like goodwill, once you've assessed those indicators, if the indicators do not show that there's a possibility of impairment, then you do not need to, continue in your analysis. What the indicators are basically saying is that, see, based on ABC, it is possible that the value of this asset has dropped. So check it. Those are That's essentially what indicators, try to do. Now, but for goodwill, we've established that you're expected to test it annually. So whether the indicators show there's an impairment or not, you are required to still test for impairment annually when it comes to goodwill. So let's look at some of the internal and external indicators. Now, for the internal indicators, those are indicators specific to the business itself. And the first we have is evidence of physical damage or obsolescence. So if the asset that you use in production, for instance, for a manufacturing firm, is damaged and therefore cannot be put to use, that is an indicator of impairment. Secondly, if the extent to which you use an asset has declined, or the extent to which you expect to use it has declined, it may be an indicator of impairment. For instance, you expected to make use of the assets in a clothing line, but due to some changes in business strategy, you have decided to maybe discontinue the clothing line or reduce the capacity of the clothing line. It means that that's an indicator for impairment. Now, you can also look at evidence from financial reporting. How has the business or the asset performed so far? What are the cash flows or profitability from that asset compared to what has been expected or budgeted for it? If there is significant variance, it could then be that it's a possibility that the asset is impaired, and then you need to carry out the assessment. Also, increase in cost of capital, which is largely what you use to discount cash flows from, from your expectations for the business or the economic value of the business of or the asset rather. Once there's an increase in cost of capital, it means that the value of the asset would decline as well, and that can be an indicator of impairment. Now, let's look at external indicators as well. If you look at the market value of the asset, the business, or the CGU, and there's a sharp decline in the market value, that is what market participants are willing to pay for that business. It could be an indicator of impairment, and so you may want to check. Now, changes with an adverse effect on technological, market, economic, or legal environment in which the entity operates. If there are significant changes within the operating environment of the business that is affecting the business adversely, you definitely want to check or need to check for impairment, because you need to be sure that what you're carrying on your books as the value of the asset is actually, the true economic value of the asset. Now, increase in macroeconomic variables such as interest rates, foreign exchange, you need to those can also provide you with reasonable insight on whether to assess impairment. And then also, if the net asset of the business that you're carrying on your books is way larger than what the market is willing to pay, or the market capitalization of that business, it means that you need to check for impairment. So those are the internal and external indicators. Okay, now we'll be discussing the timing of impairment. As we've talked about goodwill impairment and that you need to test that value. So now we'll just be talking about, well, at what time do you need to? So in a business combination, for instance, if a goodwill uh, is recognized in the current annual period, then it must be tested for impairment before the end of the current annual period. So for instance, you have done a business combination as at October 2025, and you recognize goodwill in the books. Let's assume that the end of your financial reporting period is December. It means that at the latest, by December this year, you must test for impairment as well. So that's what that means. Now, if you've tested for impairment before the end of the financial period, and then there are indicators that then crop up after you've done the assessment that your assets may be impaired, then you need to test for impairment again. So for instance, you tested for impairment in June this year, and then subsequently things have happened that indicate that the assets may be impaired. You need to also test for impairment again. Um, Now, there's no requirement for an entity to test all the assets in all the assets at the same time, including individual CGUs. There's no requirement for that. But typically in practice, what we see, maybe for ease, is that it's all done at the same time. And of course, when an impairment loss is recognized, it means that the carrying amount of the CGU needs to be written down. Okay, let's move on to the next slide. Okay, so recognizing and measuring impairment. We've talked about this to a large extent as well. So impairment occurs when your carrying amount in your financial statements is more than the recoverable amount. And then what do you do when an impairment has occurred? You reduce goodwill, and when you exhaust goodwill, you allocate the remaining impairment or the balance on a pro rata basis to the other assets in the CGU. And then there's a flaw. You can't reduce the value below, the highest of the higher of the fair value less cost of disposal, or the value in use, or even a 0 point. It can't go below that. Okay, next slide. Okay, now this we've been talking about carrying amounts, and this slide just helps to describe what it means, really. It's just the amount you've put an asset on your financial statements. So that is, you have deducted from the value of that asset or from the recognized value of that asset any accumulated depreciation and accumulated impairment losses. Now, the carrying amounts of assets in the CGU would include assets that are directly involved in generating the cash flows for that CGU. And then you also include goodwill. Then you also include what we call the share of corporate assets. Now, corporate assets are assets that support the CGUs in generating their cash flows. Now, these corporate assets do not generate cash flows on their own. Um, and examples would be like the IT infrastructure, the finance team, the HR, the building, head office or headquarters. Those are corporate assets that support the CGUs in generating their cash flows. And so the share of corporate assets for the CGU needs to be included when you're determining the carrying amount. And as I've described before, typically you do not include liabilities except you're unable to determine the carrying value or recoverable amount without actually factoring the liabilities. And I gave an example of lease when you have your right of use assets and lease liabilities as well. Okay, on to the next slide. So the recoverable amount, we've been talking about fair value less cost of disposal and value in use. And this slide just tries to buttress that. Again, fair value less fair value less cost of disposal essentially looks at what the asset is worth in the market. And value in use looks more at intrinsic value, estimating the cash inflows and outflows of the business or the CGU, and then discounting it using these terms. And then the recoverable amount is the higher of either of the two. Okay, it is important to know that value in use is entity specific, and so it's not market based. Meanwhile, fair value less cost of disposal is market based and it's measured based on the principles of IFRS 13. Okay, move on to the next slide. Now, when you're making use of value in use, because you're trying to assess the economic value that you expect to generate from that asset, you need to forecast the cash flows. And you can only forecast the cash flows for a discrete period, that would be reasonable. And due to that, you need to also have what we call a terminal period. Now, IS 36 commonly encourages that you do have a maximum period forecast of 5 years. And this is not cast in stone, this is only presumptive, right? In rare cases, maybe for cyclicality of the business, you can do a period, you can do projections that are more than 5 years, but it's a maximum period of 5 years that is typically expected under the provisions of IS 36. Now, because you have done your forecast for a discrete period and you expect that asset to still be in use for the foreseeable future, you need to capture the cash flows of that asset within what we call a terminal period. And that terminal period, you can determine it using what we call perpetual growth approach, or you can use what we call the exit multiple method. Those are the two basic ways that we can determine the terminal period value. Okay, on to the next slide. Yes. So when you are sort of trying to determine the fair value of an asset under IFRS 13 requirements, it sort of looks at what the best use of the asset would be. Now, let's even try to describe what fair value is. It's the price that a market participant, an informed market participant, would be willing to pay for an asset in an orderly transaction, right, at a particular date. Now, in determining the fair value, we look at two primary things. One, the highest and best use. Now, the entity's own use of the asset in its highest and best use can be one way to account for it. Now, sometimes an entity may not even use that asset in its highest and its best use. And you can look at it in from a perspective of if I sell it to another party, what would be their highest and best use if another party actually maximizes it more than me? So for instance, you have a piece of land and you just have a very small store in it. But it could be sold to another party that could probably develop an office space there and to bring more value, right? In that kind of scenario, it means that the highest and best use is not what the entity is currently using that asset as at that period. So that's one way to look at it. Now, we also look at what we call the principal and most advantageous market. Now, the fair value assumes the sale of the asset takes place in a principal market, and that is where that asset would be typically sold by that entity or the owner of the asset. Now, if the principal asset, if the principal market is not available, you then look at what we call the most advantageous market. That is the market that would give the highest value to the asset or maximize the returns or the amount that you can generate from the sale of the asset. Yes. And then looking at the third concept of valuation technique, right? For valuation techniques, what IFRS 13 sort of tries to prescribe is that you try to maximize the use of observable inputs and minimize the use of unobservable inputs. That is, observable inputs, things that you can readily access in the mark in that you can readily access in the market, is available to everyone, and everyone can reasonably use this information and say it's credible. Now, unobservable even inputs would be things more of forecast by management, um, and that's not accessible to everyone in the market. So IFRS 13 sort of tries to predict that you try to maximize the use of observable inputs and minimize the use of unobservable inputs. Okay, let's go to the next slide. Okay, so we have a quiz here that just helps to test our knowledge of what we've heard so far. Okay, so the question is, listed below are the indicators of impairment except A, evidence of obsolescence or physical damage. B, a significant and more than unexpected decline in market value of entity or CGU. C, increase in the cost of capital. D, improved macroeconomic environment. So we can just put our responses in the chat box. Okay, I can see lots of responses, and it seems everyone is picking D, and that's correct. Okay. At this point, up next is Suleiman, who is known for his engaging and insightful sessions. Suleiman will take us through estimating value in use, estimating fair value less cost of disposal, and the common errors in practice. Thank you.
Yeah, thanks a lot, Tumishi, and good afternoon, everyone, or good morning, rather. I hope you've been enjoying the session so far. I like to look at impairments in an interesting way. I mean, what I tell people when I'm having conversation is just imagine you are the CFO of a manufacturing company, and what you do or what you specialize in doing it is you produce solar panels, right? So um, 5 years ago, you decided to invest heavily in a new production line, expecting very strong demand for renewables, because of I mean, we know the energy issues in Nigeria, right? Now, let's assume suddenly governments just decided to change policy, right? And the policy now increase competition. I mean, because people are now able to import cheaper panels into the country, and that affected or that's affecting your demand for your own solar panel, right? If when you invested $100 million now, um, because of this, your production line is now operating at a fraction of the capacity you installed. Say you installed 100% capacity, now you're working at 30%. Now the question is, do you still retain the 100 million in your balance sheet? If I'm investing in that business or I'm investing in your business and I'm seeing an asset worth 100 million, the question is, should I continue to carry 100 million in the balance sheet? And that's really what's impairment, what IS 36 is trying to help us to unravel. Um, how do we present or how much should we carry an asset in the books when there are signals in the market, when there are signals within ourselves showing that these assets do not currently what we think they do what, right? So, and that's everything about IS 36. And that's everything Sumisha has been talking about, value in use, fair value less cost of disposal, fair value less cost of disposal. Because ordinarily, just think about it. To you, the way you will, I mean, you want to capture an asset in a way that maximizes value for you. So, and how do you maximize value? It's either you continue to use the assets or you sell it off if using it does not make sense to you, if using it does not optimize value to you. So when you use the assets for what you intended it for, that's the value you derive is the value in use. And when you realize that using it is not going to optimize value to you because from using it, you only derive $10 million. Then you say, from selling it, I'm going to derive $15 million. I mean, to any reasonable investor, is going to pick which one maximizes value. And again, that's why IS 36 says the amount you will recover is really the higher of the two, which then means you pick the higher. Now, if in selling the assets, you're going to incur some cost to sell, you're going to incur some transportation costs, you're probably going to pay some commission, um, then you have to deduct it. And that's why the standard also says it should be the difference, the higher between the two, between the fair value less cost of disposal and then the value in use. Now, it's important, it's super important that, in getting, and I also like to use an example to describe value in use and fair value less cost of disposal. And I love people to put it in perspective. So just again, imagine you inherit a small bakery that's been with your family for generations. Your family has owned that bakery for years. And what that means is that bakery is fully depreciated, but it's still working. It's working quite well. Now you just decided I mean, let me even check what I can make from this bakery, from selling bread, and everything that you manufacture, that you produce from the bakery. So you then get your cash flows. You projected that you're going to use the bakery for another 10 years. You projected the cash flows into the future. And after you've done this, discount it to today, you derive a 10 million, or let's assume it's 10,000 naira in this case. That's your value in use. So what that means is in getting value in use, you must be able to project your cash flows into the future. You must be able to project the revenue you will make from selling what the assets was established to sell, net of the costs, right? And derive the cash flows. Present value to today to get the value in use. Now, a friend of yours just offered you. He said, look, Suleiman, why not buy my bakery? And I'm saying, oh, why not sell the bakery to me rather? And I'm saying, look, how much will you buy? Or how much will you pay? So he's offering me $6,000 or 6,000 naira. So, and I'm saying someone is going to collect commission. He's asking me that I must deliver the bakery or the oven rather to him. Now, I back off all of those costs, 1,000 naira. So I'm deriving 5,000. Now, the higher of the two again is your recoverable amount. So let's start with the value in use. IS 36 provides a lot of guidance when you are uh, projecting your cash flows. It has to be an unbiased estimate because you want to ascertain if truly an asset is worth what we say it is. So your estimate needs to reflect your expectation. It has to be realistic. There has to be a lot of consistency with what you've done historically. If you've grown at a certain trajectory over the last couple of years, right? Your projections and your cash flows must reflect that trajectory, right? Um, IS 36 requires that there has to be some consistency in the way you estimate your cash flows. So, and there are um, if there are capital expenditure that hasn't been committed, because again, you're looking at the asset as is. You want to ascertain if or how much you can recover from the asset as is. So if there's any expansion you intend to do on that asset, if you haven't committed to that expansion as at the date you are assessing the impairment, it's not going to be considered for impairment assessment purposes. So you have to look at the assets as is, and your assumptions has to be reasonable. It has to be supportable. You have to reflect the economic conditions, the how to look for the economy in which the asset is situated. Next slide. Yeah, a lot of key areas where we make significant assumptions and judgments. I think a couple of hands are up. If you can, please drop your questions in the chat box. We'll take them. We'll ensure that we'll take them at the end of this session. So the first area is revenue and profit margins. Again, because you're looking at the value in use, it's largely going to be driven by cash flows. So and in deriving your cash flows, remember the top line, the first is your revenue growth. How are you projecting for your revenue to grow? How does that reflect the expected industry growth rate? How does that reflect your historical growth trajectory? Your margins, how does it compare with your historical margins? How does it compare with industry margin? It must reflect, or you must be able to explain if there are margin enhancements and be able to support it, especially if they are not margins you've done historically. Your cost drivers have to be clear. How many employees do you have in the books? What's your raw materials like? How will cost grow? How have they grown historically? Your working capital is critical. You must ensure that you estimate it correctly because they are a very important item that impacts your cash flows. So if you've maintained a working capital days of 100 days over the historical period, and suddenly you're saying you're maintaining working capital of 10 days, it's not supportable. And this is where your auditors will come in and challenge the assumptions. You want to ensure that the assumptions you are even putting forward to the auditors in the first place is reasonable and supportable. Your capital expenditure, again, remember, there is a strict guidance around the capex that will put, right? If it hasn't been committed, if there are no capital expenditure that you've committed to spend before the assessment date, you don't consider them because what we've seen happen is because a business doesn't want to consider or doesn't want to record impairment assessment, then they will say they plan to spend X amount of money and will have incremental impact on the revenue on the top line. Is usually something that we have to look at carefully. And the discount rate is the last area where our judgment is super important. We must ensure that the discount rate reflects the risk that is inherent in the cash flows. So we need to ensure that the cash flows reflects the kind of discount rate that we are putting forward. And what that means is if your impairment assessment is over a period of say 5 years, 10 years, it means that the discount rate should be computed on that assumption as well. So in terms of your risk free, you have to ensure that you pick 5 year. And I think I'm seeing questions around taxes and all of that. So yes, IS 36 um, suggests that impairments should be done on a pre-tax basis. I mean, and what that means is you apply a pre-tax discount rate, but theoretically or practically rather, why that's in the standard. Practically, it's usually a difficulty to derive a pre-tax discount rate because the items driving our discount rate computation are always on a post-tax basis, right? So what that means is the assessment is done on a post-tax basis, and then we do an iterative process to derive the discount rate for disclosure purposes in the financial statement. We go to the next slide. When you are assessing the reasonability of the cash flows, and I say this because you want to minimize disruptions to your business when you engage auditors. So you want to ensure that what you are putting forward to them, you've tested it for reasonability internally, you've ascertained if it's supportable, and you've been able to provide the evidences that supports either through your historical trends and performances or through your industry. Of course, IFRS and the valuation standards are really um, driven by market participant perspective. So if you have evidences in the market that support your assumptions as well, you can definitely bring them to support your the reasonability of your cash flow. So your cash flows must represent the best estimate of the economic conditions that will exist over the remaining useful life. And that's where you getting the industry outlook, getting the macroeconomic outlook in terms of the inflation expectations or the inflation targets for the country, the exchange rate expectations and targets and all of that. That will help you to ensure that the cash flows you're putting together is actually reasonable and can help you assess the assets for impairments. It has to be based on most recent financial budget or forecast that have been approved by management or even the board, right? And please ensure that you exclude any future cash flows expected to occur from restructuring or from improving or enhancing the asset performance. I think this cannot be overemphasized. So again, remember you're assessing the assets as is. So any cash flows because of enhancement, because of restructuring, because of improvement that you expect to do in the future that you haven't committed to must be excluded. You need to estimate cash flows beyond the period covered by the most recent budget. What it means is, remember, you are assessing, for instance, for your value in use, you're assessing it over the life of that asset. They've provided a 5 year forecast for you, for instance, or a 3 year forecast. It doesn't mean you only use the 3 years, you have to extrapolate in the future. And there are different ways of extrapolation, but most importantly, we assess if the cash flows have covered the period the growth phase of the business and the business is expected to reach stability, then we'll capture that the excess period using a concept of terminal value, using either the long-term growth rate or the industry growth rate for the business or for the assets we are looking at. Next slide. So this is a table that provides a scenario of a financial statement for an hypothetical company, ABC Limited. I think one thing is critical. They've given you the historical performance of that business. They've provided a forecast for you. And one key thing, and if we all look at it carefully, I think the first thing that jumps at me is that this business grew at a CAGR of 31%, and is being projected to grow at 45%. Another thing that jumps at me is that this business relatively achieved an EBITDA margin of 17.5% over the historical period, and is projected to, I think if you go to the next slide, is projected to achieve an EBITDA margin of 97.6%. Right. Can you see that? Now, what does that say about the reasonability of the cash flows of the financial information that have been provided? It's not supportable, and it doesn't reflect the historical performance and even the industry, because just beside the table, you will see peers, how peers are expected to grow. You will see that peers expect a revenue growth rate of 35% on average. You have, I mean, based on what we've been provided with, you or they are expecting that the revenue is going to grow by about 53%. Then you need to sort of make those adjustments to ensure that the forecast cash flows that you're using for your impairment assessment is reasonable and supportable. And that's when the auditors will be able to support the management estimates, right? And similarly, you will see the EBITDA margin. The EBITDA margin proposed, sorry, I said 97% earlier, is actually 40%. So they've proposed an EBITDA margin of 40%, relative to 17% achieved historically. And the peers are expecting an EBITDA margin of 22%. When I say peers, they are businesses that operate within the same industry as the target entity, and they operate in the same market. So margins generally are expected to be the same for businesses in similar industry. So these are areas that we need to pay attention to when we are conducting impairment assessments. So when you come up with this kind of cash flows, you need to sit back and make the necessary adjustments and be sure that it is reflecting the historical performance, and is also reflecting the peers. So next slide. So, as I've mentioned, I think I've covered majority of the things we have here. Revenue is projected at 53%. It's higher than the historical performance of 32%, and even higher than the peers average. So if you do this, if you use that revenue as is without you making the necessary adjustments, what that means is you are going to be overstating your value in use, and you're going to be arriving at a very wrong conclusion. And one thing you don't want to do is to conclude that your asset is not impaired when it is indeed impaired, right? Uh, so you look at the cost of sales as well, and in line with the margin, I mean, vis-a-vis the EBITDA margin, to see this business is projecting an EBITDA margin of 40%. Historically, they achieved EBITDA margin of 17. Peers are expecting EBITDA margin of 22%. There's a disconnect, because what that means is if you adopt this margin as is, right, it means you're going to be overstating your value in use, and similarly, it's possible you'll be arriving at a wrong conclusion as well. Again, remember how the people that are relying on the financial statements, they want to make a decision. They want to make a lending decision. They want to make an investment decision. You don't want them to make those decisions on the back of a wrong financial statement. So it's always critical that we assess all of this carefully. Next slide. And how do you derive your cash flows? So if you can see the screen, I expect that we all can see the screen, of course. So But if you were not looking at the screen, I would suggest that you do right now so you can see how we indeed come up with the cash flow. So you get the cash flows for each of the period. It's usually from habit. You back out your tax. You adjust for depreciation because it's not a cash item. You had it back. You remove your changes in working capital. You move your capex. Again, ensure that this capex is maintenance capex. Uh, any other capex that is not maintenance, it's and if those enhancements, right, have not been committed for, then you will not be reflecting the true worth of the value in use. Now, it's critical I mentioned that when you are computing your value in use, please ensure that you are comparing apples with apples. If your value in use is including, I mean, if you can't derive your value in use without including some liabilities, some operating liabilities, then you include them, but please ensure that your carrying value also reflect those operating liabilities. So that's if an area where IFRS provides some guidance, right? I'm not sure I can remember the exact paragraph, but it's clear as well. Next slide. And this is the way we come up with the discount rate. So again, ensure that your discount rate reflects the risk in your cash flows. If you're using a local currency cash flow, if your cash flow is based on local currency, ensure that your discount rate is also in local currency terms. So what I'm saying in essence is that if it's a Naira cash flows, then your discount rate has to be Naira discount rate. So starting with the federal government of Nigerian bond yield, you build it up until you get your cost of equity, get your cost of debt as well, and then you do your weighting based on your capital structure. And please ensure that all of these reflects the markets. IFRS is clear, IAS 36 is clear because you are assessing it from market participants' perspective, right? And that's why the standard says even if you look at your value in use and the asset is impaired, you don't conclude that it is impaired yet because it might be that you are not maximizing that asset, right? So then go to the market and assess it. What's the fair value less cost of disposal? If on the basis of that is not impaired, then you won't capture any impairment. So what we are saying in essence is everything has to reflect market participant perspective. And that's why you're going to the market to get the FGN risk free. You're going to the market to get your beta. You're going to the market to get your cap structure. Okay. How do you estimate your fair value less cost of disposal? If you remember the bakery illustrative I mentioned earlier, I said uh, you got an offer from a friend, right? And that friend said he's going to buy the bakery from you at a certain amount. Now take some steps back. Let's assume nobody has actually offered you, but you need to ascertain the fair value less cost of disposal. How do you do it? It's not difficult. What you're literally doing is you're going to the market, looking for businesses that are similar. You're looking for assets that are similar that have been traded. And uh, on the basis of how much they've been traded, you use it to derive the fair value or how much you will trade these assets if you are to trade in that asset today. Or you look at businesses that are similar or assets that are similar to what you're looking at, whose shares are traded on an exchange, right? That is liquid. Then you get the price in which they've been traded, and you use that to form the basis of your fair value less cost of disposal assessment. But remember, it's not just fair value. Ensure that you less your cost of disposal. And there are two ways I've tried to describe them. It can either be the trading company shares or transactions in those in those untraded companies, or even those traded companies that have actually been bought or sold in the past. Next slide. And it's simple. You just need to look for companies that are similar or transactions that are similar. You select the performance metrics that reflects or that drives the performance of that business. You apply the multiples on that. You select the type of multiples to be applied depending on the industry or the kind of business that you are assessing. You perform some analysis to see to see what kind of metrics or what kind of metrics is the subject entity is trading at, right? Then you adjust and apply selected public companies multiples, and you assess if there are any premiums or discounts that you have to apply, and then you estimate such premium and discounts and apply it. Next slide. So this is a table or a tabular representation of how a fair value less cost of disposal will look like. I'm assuming it's a manufacturing company. We've used EV to EBITDA. You get the EBITDA of the subject asset or the subject entity. You get the EV to EBITDA of that comparable companies or the transactions that you've adjusted for. If for instance, they are not in the same country, you make adjustment for country risk. If they are not of the same size, you make adjustment for size, and all of that, right? Then you get your enterprise value. Um, Again, if you stop here, remember what that means is that you've assumed that the carrying value is also on a total asset basis, it's not on a net asset basis, right? Um, if it is on a net asset basis, then you have to back out liabilities from your enterprise value here, right? And then because the entity you are looking at is not traded, so you adjust for DLOM. Uh, when I say DLOM, I mean the liquidity discounts for not being traded, right? And then you back out any incidental cost of selling, like transportation costs, like commission. If you are engaging or if you're going to engage an investment banker to sell, you back out the cost of disposal, and then that gives you the fair value less cost of disposal, which you then compare with your carrying value to see if there's any impairments or not. Remember, there will only be impairments if your carrying amount is higher than your recoverable amount, right? There are some errors that we've seen and that we continue to see, but we hope going forward together as market participants we can minimize in our markets. Uh, Remember, goodwill can only be recognized from a business combination, and Tumishi clearly explained this. So, I mean, a number of us perhaps will be wondering how does goodwill even arise in the first place when you acquire a business? And remember, it has to be a business combination. If it's an asset sale, no. But if it's a business combination that is in line with IFRS 3, the standard expect that you do a purchase price allocation, and then hopefully that assessment will result in either a positive goodwill or a negative goodwill, being the gain on bargain purchase, right? If it's a positive goodwill, then it's an asset that you expect to bring in the books, which is how really goodwill comes on board. But if it's not any of that, you can't sit and say or feel you've made a good name and hence you want to internally generate a goodwill and put it in the books. Is not permitted based on the standard. Otherwise, we can have distorted financial statement everywhere because everybody wants to enhance their asset because of a good name they feel they've made or some relationship they feel they've built and all of that. Goodwill is recognized in an entity's consolidated financial statement when the business combination is effected through the acquisition of a controlling interest in another entity. So if it's a non-controlling interest, even though You might still do a PPA, but I think those assessments are really for disclosure purposes, not because you need to then bring in goodwill into the books. You must ensure that you apply IFRS 3 correctly because look, while a lot of people, and we see it a number of times when there is an acquisition, people think once you remove or you compare the net assets and the purchase price that you've paid, the excess is goodwill. No, that will be a wrong application of IFRS 3. The standard actually expects that you check if there are other intangible assets that you've recognized or that you've acquired as part of that business combination that you must allocate some value to before you then say the remaining is goodwill. For instance, you are buying a business. That business has made a very good name for themselves. They have a brand, a strong brand in the market, and luckily, that brand is recognized by the market. Now, you won't say all the value is attributable to goodwill. You need to value that brand separately, bring it into the books, and any unascertained or unallocated amount is then what you can attribute to goodwill. So goodwill is really a residual after you've allocated the excess to all intangible assets. That residual that you cannot allocate to any other assets is a goodwill. So, and we've seen instances where people allocate goodwill to CGUs with no synergies arising from the business combination. So, there's a business segment that doesn't even have any contribution, that's not contributing to the generation of the cash flows from the business you've acquired, and then you allocate goodwill to that CGU. It's not allowed. Next slide. So, the points we need to note, again, goodwill is an intangible asset that arises when one company acquires another for a price greater than the fair value of its identifiable net assets. It's subject to annual impairment testing under IFRS. It's actually one of the assets that you have to test for impairment annually, whether there is an indication or no indication. And if there's any reason to test it, even during the year, you must do so. And that's why we've seen businesses that because they do a 9-month financial statement or a 6-month financial statement, they might need to test the goodwill for impairments as part of the 9-month, 6-month reporting. And fair value estimation can be achieved through either income approach or market approach or asset approach. So they are all valuation methodologies and they are encouraged to be used. Next slide. Okay. I believe it's time to hand over back to Motunrayo to anchor the Q&A session. So please, this is the time for you to ask all your questions. We encourage you to drop them in the chat box. Thank you.
Thank you, Sulaimon. It was quite an interesting session. So thank you to all our facilitators, Abimbola, Tumishi, and even Sulaimon. It was quite interesting. I believe, and I'm very sure, not even I believe, I'm sure that we've been able to provide an understanding of the concept of impairment, the frameworks guiding it, and as well as the measurement standards. Now, we'll move to our question and answer questions. We've already seen some questions in the chat box, right? So please drop more questions if you do have, and we'll ensure to take them as time permits. We'll start with our first question, and this is addressed at Tumishi. Please, what are the risks of overvaluing or undervaluing a company or business?
Okay, thank you, Motsuraya. Okay, so let's start with overvaluing a company or a business. So that means the company's value is perceived to be higher than its true worth. Some of the risk would be around poor investment decisions. So it means that investments would pay too much for the business, and they would be expecting returns that might materialize. So it means that subsequently they would have to write down their investment, right? There's also reputational risk because you can overvaluation or overstated valuations can damage your credibility with investors, your creditors. Can be fines and lawsuits, because people don't joke with money. And then when that kind of thing happens, you may have difficulties with financing in the future because people will not trust, what you're putting out there. The market would punish you and continue to believe that the company's value is overpriced, and so they may not want to fund you. All right. So those are some of the risks, with overvaluing um a company. Now, for undervaluing, it's just the flip. It means that you've sold yourself short to investors. You have missed out on capital or possible investments that you could have gotten. You have a weak bargaining position as well. Management is not able to invest properly or maximize returns for shareholders due to the suboptimal valuation that has been done. So, um, overvaluation or undervaluation, none is good, right? So you run a risk in overvaluation of losses, impairment, reputational damage. Undervaluation, you miss out on opportunities, you have a weak positioning, right? So it's just important that evaluation is done appropriately. Yeah, thank you, Martin.
Thank you, Tumishi. And I believe it has answered your question. Thank you. I can see the clap emojis. The next question says, can you shed more light on what principal market is? I think that was when we were discussing the fair value less cost of disposal.
Yeah.
So just shed more light
Yeah.
on what the principal market refers to.
Yeah, so principal market is essentially the market where you typically sell that asset. And I'll try to give an example. So if you're in the business of crude oil, for instance, the international market is where you sell crude oil. And that's the principal market. So if, for instance, a barrel of crude oil is trading at $100 in the international market, and someone else is offering you $120, because the principal market is the international market, you have to do your valuation or your fair value analysis based on the $100 in the international market, right? Because that's the principal market. I'll give another example. Let's assume that you have the shares of a company, let's call it Company A, and Company A is traded on NGX, which is the principal market for the buying and selling of shares in Nigeria. Uh, you then get an investor that approaches you and tells you that this Company A would buy a share from you at 200 naira per share. Meanwhile, it's being traded on the NGX, for instance, at 50 naira per share. When you're doing your fair value analysis, you base it on the principal market, which is NGX in this example, at 50 naira per share. So that would be your fair value analysis, because that's what is obtainable to all market participants and it's defendable.
Thank you, Tumishi. That has provided much insight on what principal markets is all about.
Thank you, Mato.
Yeah. The third question, which is also still directed to you, why is it that goodwill cannot be reversed? I know it's required by the standard, but what's the reason behind it?
Hmm. That's a very interesting question. Um, so if you think about it, goodwill is not an asset that can generate cash flows on its own. It's meant to support the identifiable business. That's the cash generating unit to, to provide additional economic value. sort of. And so, what you do not want to do when you have goodwill is when it's written down, for instance, you do not want to be reversing and causing that variability in your financial statements. And I'm giving you my own perspective because if I pick your financial statements today, I see that you've written down goodwill due to some indicators and it's impaired. And so your profitability has declined. Now, in subsequent period, you believe that those conditions are reversed and so you should have a reversal. And then you then sort of increase your profitability again. It just makes the business appear a bit unserious or they don't know what they're doing. It causes variability in your financial statements. So it's best that you leave it written down once it is written down. Um yeah, so that's my own take on it. And then the process of trying to um ascertain goodwill is really from the initial assessment of business combination under IFRS 3, right? So it may just entail a whole lot more of technical hurdles and trying to prove to auditors and investors that that what you actually paid in excess for is actually has true worth. Um, I don't think I do not believe that it's a process that creates the kind of value that you would want as a business. The variability involved, the technical orders involved, it may not just be worth it going through all that stress. Yeah, thank you, Motso.
Thank you, Tumishi. Thank you, Tumishi, for answering that question. We'll go to another question, also to you, Tumishi. How much judgment and subjectivity is involved when undertaking valuations for complex or unique assets? What level of subjectivity and judgment do we think is involved when undertaking valuation for complex or unique assets? I'm sorry, Tumisha, you're muted.
Oh, sorry, I just observed that. So in any valuation that you do, there's always the bit of subjectivity, and so there's no valuation. Even if it's a complex or simple one, there's still judgment that has to go um, in deciding what the final value should sort of be. Now, for more complex ones, um, to the extent possible, you want to reduce subjectivity so that whatever you're presenting to the final users is defendable. They can actually even assess it themselves and see that what you are putting forward is reasonable. Now, even if you're going to be using subjective information, as much as possible, you try to make it something that they can source from they can source in the public. And when you are making those judgments, you document the judgments you've made to prove that they are reasonable, right? So it's not just about making judgments, but making judgments that is reasonable to anybody that picks up the valuation document that you have. So it is impossible for you to take away judgment from valuation because that's where the human element comes into the picture to assess whether what your model is throwing out is right, looking at the current economic realities and other information that have been made available, right? So yeah, judgment and subjectivity cannot be taken away from valuation, whether it's complex or unique assets or even simpler valuations. Yeah, thank you,
Thank you,
Musa.
Tumishi. Yeah, thank
Yeah.
you. I think you answered that very well. Yes. Hi, Sula. My next question is for you.
Okay.
Um, can we consider seasonal variation peculiar to some business in driving the revenue and profit margin growth estimate? So I think this was when we were, talking about the financial statements that was presented. So they're asking, can we consider the seasonal variation peculiar to some business in driving the revenue and profit margin growth estimate?
Yeah, absolutely. What's important is for your cash flows to reflect your historical performance and your future outlook. So if indeed you expect seasonalities, you expect variations, you expect short-term fluctuations to happen, you have to definitely consider them in your valuation, in your impairment assessment rather. So the answer is yes.
Thank you for that. Thank you for answering that. Another question for you. This was when we were talking about the discount rate for that was when we were talking about the pre-tax tax considerations, basically. I know you mentioned you would giving little insight, but you still want to understand what are other tax considerations can consider in impairment assessment.
Yeah, I mean it's critical that you ensure that your discount rate reflects the tax rule and the tax law. So, for instance, at the moment, historically, we've had to adopt, I think, about 33% or 32.5% at some point, where we were capturing in terms of the marginal tax rates, where we're capturing uh, the CIT, the education tax, and then the police trust fund. But with the new NTA now, the new tax act, which has sort of now put everything together in a development levy of 4%. So what we expect to see going forward is that in valuation assessment, your marginal tax rate will now be 34%, especially if you're looking at an assets that pays CIT. If it's in oil and gas sector, I mean in the downstream, so that will be um, a completely kind of rate where you have to now capture the hydrocarbon, CIT, and all of that. So yes, there is a pre-tax, post-tax conversation, which is really an IFRS requirement saying you have to do it on a pre-tax basis. But I mentioned earlier that there is a difficulty in assessing pre-tax discount rates. And what we usually do is to do it on a post-tax and do an iterative process to derive the pre-tax for disclosure purposes. Thank you.
Thank you, Limon. Thank you so much. Now, this question says, why use EBIT and not EBITDA when we are performing the value in use computation? This is to use Limon, and I think this was when we were giving a breakdown of, how we do our value in use computation. So why
Yeah,
start with
thanks.
EBIT and not EBITDA?
Thanks, Mutsu. It's I mean, however you start, what's important is to ensure that you capture the right amount of tax, right? And why we start with EBIT is because of the allowable and the assumption that your depreciation is reflecting the capital allowance that the tax authority will allow for tax computation. You back it out, and at the end of the day, we're adding back the depreciation, right? So if you start from EBITDA, it's also correct. That means you won't have to add back the depreciation, but you must ensure that you've accurately estimated your taxes and consider the possibility of tax authority allowing your depreciation or capital allowance, as the case may be, for tax purposes.
Thank you. That works perfectly. So, Limon, this is also directed to you. Right. It says, what is the standard methodology of computing and adopting the cost of capital to be used in the DCF approach? Is the adopted methodology peculiar to a specific industry? What's your advice, please?
Yeah, thanks, Mutu. I think this country is one of this country's estimation is really one of the aspect of valuation where it's really not in terms of the methodology or the standard is really not peculiar to any industry per se. So I mean, rather than the nuances and some of the assumptions that you use, it's really the same standard methodology. CAPM, you estimate your discount using the capital asset pricing model. For some of us that done accounting exams or CFA, you must have heard of CPM. So you use your CPM where you build up from your risk-free, adjust for equity risk premium and then beta, and then adjusting for how fast, if there are any risk that hasn't been captured in your cash flows that you want to reflect here. So things like size risk premium, things like firm specific risk premium, you sum all of them together to derive your cost of equity. And then you derive your cost of debt, which is really your cost of equity and reflecting the credit spread to capture the the credit risk of the entity you are valuing. And then you weight the two based on the optimal cap structure of the entity or what the peers capital structure are. So it's a standard methodology, to be honest with you. Where I've seen differences across industries, one, of course, you will see beta will be different across industry because different businesses react to the market in a different way, depending on how the market is. Then I've seen instances where the taxes are different because of the variations in terms of how much taxes you pay across industry. For instance, earlier I mentioned how oil and gas will pay a different kind of tax from a typical, say, manufacturing company. I hope that addresses the question.
Thank you, Slimon. I think it does address it. Hi, Mr. Tumishe. This question is for you. You mentioned that in impairment testing management forecasts, you benchmark against historical performance and peer metrics to assess how reasonable the forecast is. My question is, what happens when those benchmarks are not reliable indicators of future performance?
Hmm. Okay, that's an interesting question that needs more context, actually. Typically, we expect that historical performance and peer benchmarks would be good basis for you to forecast your cash flows in the future. And even if your historical is sort of different, maybe due to economic, regulatory, or technological changes, it will mean that you now have a new basis that sort of supports the cash flows that you're projecting. And then everybody can assess the reasonability. So if that's the situation, it means that it's something that is obvious to everybody, every party, and not just you alone. It's something that is available to the entire market as well. Or it could be that you're doing an investment or an upgrade to your current operations, and then that additional investment means it would capture some additional values, and then you see cash flows improvement. So what I'm trying to say is this: even if your historical performance or your peer benchmark, based on your expectations, do not sort of reflect the possibilities of that company into the future, it's something when you're sort of doing your forecast, you'll be able to sort of put all those assumptions and judgments together that anyone who picks up the document understand why your forecast is deviating from the historical performance and peers benchmark.
Thank you. I think that answers it perfectly. That answers it well. All right. The next question says, please, can you do a recap on what you've said about discount rates, the practicalities of using a pre-tax rate or a post-tax rate? Sulaiman, please, I'll address this to you.
Yeah, again, what I've said is practically impossible to estimate the pre-tax discount rates. And I'll tell you why. The assumptions driving discount rates are all on a post-tax basis. If you look at your equity risk premium and you break it down, you distill it, you see the calculation of equity risk premium is the equity market return minus risk-free. The equity market return is the return the equity market has shown over, I think some people do it over 50 years, right? The equity market return is on a post-tax basis. Of course, businesses have been taxed. So they're not going to disclose or report returns that is on a pre-tax basis. So the question is, how do you go back to go and estimate the taxes that each of those businesses paid? So it's practically impossible. And the standard, I think IASB actually acknowledged that, and they issued a guideline to say they also recognize that it's might be difficult to do this, and what valuation professionals and the guidance they provided is that no, you do it on a post-tax basis, and then you reconcile through an iterative process to derive the pre-tax assessment. Thank you.
Thank you, Sulaimon. I think the final question that has not been answered in the chat box is just, yeah, it's just if the IRR is higher than the computed cost of capital, can we adopt IRR instead? And what is the finance implication, especially to investors, knowing well that IRR is internal? I'll address this to Sulaimon, please. Hi,
Okay,
Sulaimon.
I can take
Okay,
that. Yeah.
thank you.
So the question is essentially if IRR is greater than cost of capital. Can you just quickly repeat that?
Yes, if your IRR is higher or greater than the computed cost of capital, can we
Mm,
adopt the IRR instead? And what is the finance implication, especially to investors, knowing well that IRR is internal?
okay. If your IRR is just a way for you to assess the viability of your investment. So if IRR is more than your cost of capital, it means that the profitability from that project or that business gives you a return that is more than the cost from your sources of capital. And then investors typically like to see that kind of scenario because that's what means that the venture is profitable to them. And that's my understanding. So, but as it relates to discount rate, and I may not be clear on what the person is actually trying to say here, but for viability of a business, right, higher than cost of capital is usually a good thing.
Yeah, if I can add to that, Sumishi, I think we actually do an assessment of IRR versus cost of capital, especially when we are doing the initial PPV, initial allocation of purchase price to goodwill. And why do we do this? What you're trying to say is, you're trying to ascertain the initial, I mean, at the point of assessing of or investing in that business, you want to see what's your return expectation, what's the IRR that you were expecting from investing in it, right? Now, if you have that somewhere, now in doing your PPA, in doing your purchase price allocation, right? The question is, how does your cost of funding or your cost of capital, remember, whether higher or cost of capital, they are both return concepts, right? Um, your cost of capital is literally your minimum return you must derive, right? Um, from I mean, the minimum return your investors expect, your providers of capital expect, which is now your own cost, right? Now, in doing your viability assessment or anything, if you decide to use a higher because it's greater than your cost of capital, what you are technically saying or what you're technically doing is you are putting the business under a more stringent assessment. I mean, because you already feel this IRR is greater than your cost of capital, then if you test it using a higher rate, right, you're assessing if using that still makes sense for you to pay. So if, for instance, of using a cost of capital of 10%, where you're going to get a higher value, you decide to use the IRR, right? Because you want to ensure and confirm that, look, I can have enough to pay my investors, right? But again, remember, if you're doing an assessment for IFRS purposes, where the standard is clear, it must be from a market participant's perspective. Remember all the definitions Tomisha gave. It's a principal market, is an active market, is a market in which transactions are still going to happen at arm's length, right? So you have to rather prioritize the use of a cost of capital that reflects market participant expectation rather than your own internal rate of return expectation, if I can put it that way. I hope that answers the question.
I think it provides absolute good clarity. Thank you. And with that, I think we've addressed all the questions in the chat box. At this point, I would want to say thank you once again to our facilitators for the insightful discussion and to everyone who participated in our question and answer session. Fantastic. And to our participant, our amazing participant. It's so good, and we are delighted to have you on the call. Thank you. At this point, we've come to our final segment of today's webinar, and I will hand over to Sulaimon Ishola to give the closing remarks and just talk about our different service offerings. Thank you.
Yeah, thanks, Mutsu. Of course, I think at Deloitte we do quite a number of things. It's a one-stop shop for almost everything advisory you require, from corporate finance to transactions to real estate advisory, economies, and all of that. Within the evaluations and modeling team, which is a team that hosted or that's hosting this session, we value business interest, intangible assets, PPAV, fairness opinion. We support valuation for financial reporting. We value funds, collateral, value biological assets, assist with impairment assessment. So if you encounter any challenges conducting valuation, please just feel free to reach out to us. Or if you consider that you need support, especially considering the time of the year we are in, a lot of businesses require or is required to submit their financial statements ahead of the deadline in March. If necessary, please feel free to reach out, and any members of the team will be willing to support. It's a team of chartered accountants, CFA charter holders. I'm one myself. Tomishe is one himself is a charter holder. Motunra is also a charter holder. So we're more than happy to provide guidance and support as required. Yeah, thank you so much for joining, and have a good rest of the day. Bye bye.